This video is going to be looking at costs and two specific types of costs. It's going to consider fixed costs and variable costs. Now, a fixed cost is any cost that must be paid regardless of output. So it doesn't matter if they're producing lots and lots of products or no products at all, they'll still have to pay these costs. Variable costs, however, are completely dependent on output. So the more they produce, the more expenditure they'll have because these costs will be directly based on how much they produce. Now let's give a couple of examples. If we think about these pictures, we've got rent. So for example, if you think about a landlord that's renting out a property to a company, that company, doesn't matter if they produced zero and they've just literally just started up that month, they'll have to pay that month's rent. The landlord is not going to be happy to wait until they've produced a certain amount of goods. They'll want that rent money every single month. There'll be a fixed term contract. Now, in terms of when that fixed term contract expires, then yes, the landlord can change the contract for the next year or whatever the duration is. But during that term, during that agreement that they are in that property, it is fixed. If you consider the next one, we think about stock. Stock would be a variable cost because it's based on output. If there's high demand, then they'll need more levels of stock. If there's high demand, they'll have to buy more levels of stock. So therefore, the variable costs included or involved within stock would get higher and higher the more demand. That's not a bad thing because obviously it shows demand, but it just shows that more costs will be taking place. Now, in terms of electricity, this one's slightly different. I haven't put the definition of this in, but it could be argued that it might be semi-variable cost. Now, a semi-variable cost is almost like a combination of both. It might have a fixed term contract, but if they go over that limit, then they might have to start paying extra for how much they use. Other types of examples of this is broadband, is maybe water, those type of bills. Now, semi-variable doesn't often come up in the GCSE exams, so it's not something to be too concerned about. However, it is worth mentioning. Other examples, if we consider the raw materials or the ingredients for food in this left-hand picture, imagine it was a restaurant, and a restaurant, when they were producing meals, they needed this ingredients, then this would be considered a variable cost. So in terms of other raw materials, you think about oil maybe, you think about different plastics, wood and so on, they would all be variable costs because they'd be used to produce the good. Now again, a similar example could be packaging. So if we think about packaging, the more products that are sold, the more products that need to be produced, then if those products are being produced, they'll need the packaging to go with it. So packaging is also a variable cost. Now, if you think about loan repayments, again, similar to the rent example, a bank manager will not negotiate in terms of when you make that payment. You'll have a fixed agreement, and that loan repayment will be expected to pay back each month, depending on the duration of your agreement. But it would be definitely a fixed cost because it doesn't have any relation to output at all. Now, the next one is slightly different. So we've got wages and we've got salaries. Now, a wage is often dependent on hours worked because wages is what's paid per hour. Now, in terms of hours being worked, you'd probably expect an employee to be asked to work more hours depending on the demand within the good or service or whatever the business might be. So therefore you could say it actually is related to output because the more output that is being produced, the more they might need those workers for those specific types of hours. So therefore wages are often considered a variable cost. However, salary is a fixed term agreement, often an annual agreement, and they'll get paid the same each month. It doesn't matter how much they produce. If they've not been very productive 1 month and not produced a lot, then yes, the manager may investigate, the manager may be scrutinising them, they may get disciplinaries, however they'll get the same salary. Other types of examples of remuneration or payment, if we think about piece rate or commission, so piece rate is payment based on how much you produce, and commission is payment based on how much you sell. You can tell that both of them are dependent on output, so both of them would be considered variable costs. Now, often when considering a variable cost, you'll realise that a business doesn't often produce just one product. Can you imagine a stockroom with just one unit? It wouldn't happen. They would sell lots of different products maybe, or they might sell lots of units of one product. So if they sell lots of units of one product, yes, obviously you calculate the variable cost, but you will also have to calculate the total variable cost. Now the total variable cost, all that means is the cost of production for all of the products that are being produced. So again, imagine this pen. You've got a pen that is being it's being produced at 75p. So every time they produce a pen, it costs them 75p to produce. It might be the plastic involved, it might be the ink cartridges involved, and however, this company specifically has produced 7,250 pens. So therefore, what you do is you get your units, 7,250, and you times it by 75p, so 0.75, and you get a total variable cost of £5,437.50. So even though it costs them 75p to make one pen, all the pens that they've produced is costing £5,437.50. So let's have a go at these three examples, which are a little bit more challenging. If you pause the video and have a go at the three questions, then we can go through the answers. So the first question, how you do that is, because they're selling 100% more pens, then you double the amount that they were previously selling. So you do 7,250 times by 2, which would give you 14,500. So that at the moment is the amount of units, the amount of pens that they are producing. Remember, it costs 75p to produce, so you times it by your 0.75, and you'd get a total variable cost of £10,875. The second one, because it's 20% increase on the amount of pens that they've been currently or originally producing, you'd simply do the calculation of times it by 1.2, because that would get you a percentage increase of 20%. So that would get you 8,700 pens in total. So you do your units times your variable cost, so 8,700 times by 75p, and that would get you £6,525. The third question, you'd find out what 10% is of the total amount, which would be 725. So 10%, obviously it's a reduction, so 7250 minus 725, and you'd get an overall output of 6,525. Times that by the 75p, and your total variable cost will be £4,893.75. Now you'd have to show your calculations. It's good practice for many reasons. One, it could, depending on the type of question, get you additional marks in terms of obviously calculation marks. Two, if you do make a mistake, if you're checking over your paper, maybe towards the end of the exam, it's probably easy to spot that mistake, and it's easy to make sure that you rectify it. And three, again, as I've said before, it's good practice. Once you've calculated your total variable costs, then you can add it to your fixed costs. Now, there isn't really a formula for fixed costs. What you may get is a firm has lots of different fixed costs, so you might have to add them all up. Or again, they might try and trick you a little bit and say that this is the rent, for example, for 1 month, work out the annual fixed cost, so you'd have to times it by 12. But really, there's no formula for fixed costs. So the total cost formula is fixed cost plus total variable cost. Now I've just mentioned really quickly here, sometimes the exam papers don't always use the word total variable cost, and they just expect you to do that. So sometimes you may get fixed cost plus variable costs. Now you should be able to use your common sense in terms of assessing whether it's a variable cost or a total variable cost. If the number seems very, very low and seems strange for the amount of units that are being produced, then again it's probably just their variable cost, so then you'd have to times it by the units to get the total variable cost. So this is an example question. Have a go, see if you can calculate the total costs, pause the video, and then we'll go through the answer. So how you do it. Within this scenario, it gives you all this information here that I've highlighted. So the number of pots being produced is 150. They're selling each pot at £10. So you'd only use these to calculate the revenue It's got nothing to do with costs. So then you go to the variable costs, so that's £2. So it's told you that every pot that they produce, it'll cost them £2, but they're producing 150. So you do your total variable costs. So your variable cost of £2 times your 150, and you'd have £300 total variable costs. But remember, we're looking for total costs, so we also need to consider the fixed costs of £500. So you simply do your 300 plus your 500 and you get 800. If we look at the options, it's obviously here C.